Welcome to FM Radio, your go-to podcast for everything in the world of funds management. Whether you're an experienced advisor, a seasoned investor, or just starting your journey, we're here to break down the complex world of funds management, all in a way that makes sense. In this week's episode, we're looking back at a year that has served up a number of economic and geopolitical headwinds. But over the past 12 months, we've also seen tailwinds that have helped the Elston Income portfolio to deliver on its promise to investors. So on the first anniversary of this new portfolio, we thought it would be good to talk to two of the portfolio managers who launched this offering and helped steer it to its first birthday. Elston co-founder Bruce Williams leads the large cap strategy, and Alastair MacLeod is part of the multi-asset team. Bruce, Al, happy birthday. Welcome to the show.
Thanks, Pete.
Thank you, Peter.
Okay, so there is no birthday cake in the studio. We haven't got time for that sort of nonsense, but it is worth recognising that the Elston Income portfolio is 1 year old, and it's also good to review what that first year has been like. This financial year's gone through, quite a few twists and turns, hasn't it?
It certainly has. It seems to be a continuation of just a lot going on with the globe more generally over the past few years. This year we've probably seen the rise of AI really start to gain traction, and that's had massive ramifications and will continue to have massive ramifications. You've also got the Iran war, which was probably not expected, when it did happen, it was expected to finish reasonably quickly, but now it's dragging on as well.
But a year ago, we were talking about tariffs and, what's coming out of the White House and how it's moving market. And I guess that's been consistent. But yeah, you're right. Now we've got all these other geopolitical shocks and everything else. And
yeah, the tariffs haven't gone away either. It's almost just been dropped down the agenda of, the biggest headline for this month.
It also probably, the impact of the tariffs was expected to be absolutely huge. And now it probably hasn't been as big as what the market was expecting?
No, I think that's been initially when you get an announcement, sometimes there's an instant market reaction. But yeah, I think when we looked at it, it was like how long it's going to take to implement these things or negotiate a free trade agreement. It takes so long. So, I think by the time they actually came to pass, a lot of it was sort of being able to be dealt with. And like a lot of things in markets, there's an initial shock, and then markets recalibrate and sort themselves out, and we move on.
Is the same thing going to happen with AI, Al?
I think AI might have a bit of a longer tail, but yeah, I think. But in some ways, yes. In that, I know that there's a Moore's law where he talks about when new technology or new things happen, we often overestimate the impact in the short term, but then over the long term, underestimate just how transformative that technology is. And I think that's probably a pretty good, analogy or rule or template to use for how AI is affecting us at the moment.
And that's something we saw in the not too distant past. Well, not too distant past for old people like us with the tech wreck. In terms of back then, the transformative technology was the internet, and all this blue sky was being priced in around what it's going to do. That eventually unwound, but the benefit was there. It just took a lot longer than what the market was expecting to actually implement.
And the companies that benefited were not the ones, they weren't even around, a lot of them that when the initial technology came out. So I think there's probably some similarities to that as well.
Well, it's with AI. One of the major drivers now, I can probably talk to this more than I can, in the US is the actual build out to allow it to happen. So if you think about, there's a certain amount of capital building that is required, it is dominating. It's not office buildings, it's not, shopping centres, it's data centres, and AI build out is sucking up all the capital into that one thematic at the moment. And so it's already having a huge impact, yet to see fully implemented within businesses. People don't quite know what it looks like yet because it's changing so quickly.
And that's bricks and mortar. That's very different to, as you said, it's not putting .com after your name and expecting to get a hike on your share price. This is actually, the money is being put into real infrastructure that's going to be around for a long time.
It's real infrastructure, and then it's also obviously takes an enormous amount of power to run the AI side of things. And so where's the power going to come from? Can the grid handle it? Are renewables going to drive it? Is it people going back to coal and gas? in order to drive it. Who's going to pay for it? Because if you've got more demand with limited supply, that goes to pricing. So it's multifaceted.
When you think of AI being, to me, the biggest thing on the list we talk about the last 12 months, it's a major disruptor. It's also a major driver of potential big opportunities. Some of the things that Elston has been through over the years, you talked about winding back the clock. Elston, you've been through GFC, you've been through COVID. What did you learn from that? Now, how did you actually navigate those challenges?
Oh, that's a difficult one because they're all different. I mean, ultimately, you've got to always be looking at what it is you're doing and how you're going about things and how you're processing information. It's also where the exposure is greatest. So with Australian equities, for example, exposure to that AI thematic is reasonably limited, whereas the epicenter of it is really the United States and the United States market, which Al could probably talk to more than I can. But you just got to be constantly adjusting how you go about things and particularly how you process information and really looking at scenarios that you've probably never before considered. And the difficulty with that at this point in time is it's such early days that you just don't know. Like a great example might be travel. As an example, a company's going to be completely disrupted by AI. Will people no longer use a travel agent? Will they get AI to do it all for them, including all their currency management, all the other bits and pieces that goes along with travel? Or will it be supplementary to a travel agent and make it a lot more efficient and easier for them, and they provide that service for you at a better price that is a better service overall? And this is where you don't know as yet. You've got an inkling, and it's certainly been reflected in pricing in a lot of instances in terms of the value of the companies that they will get disrupted. But whether they will be that disrupted is an unknown.
Yeah, I mean, I think there's a glass half empty or a glass half full way of looking at AI. I mean, the glass half empty is we can do the same amount of productivity with half the people, and that's probably not an optimistic way to look at it. Or the other way is actually we can do 50% more with the same amount of people. Yep. And that you see productivity gains and growth in the economy, and actually, I sort of tend to think that is, we will get these productivity gains and it will benefit society as a whole, but it's probably just going to be a bumpy road on our way to getting there.
And at the moment, everyone, it was particularly domestically, inflation, we've just had interest rate rises on the back of inflation. Ultimately, you would think AI would be deflationary. So, if your accountant is doing your tax return and they're using AI to do it and they're saving a lot of time and a lot of manpower doing it, ultimately because you want that product for less. So, that they can look after twice as many clients, but probably charging less for it. Yeah. So, if it is deflationary, that's not a bad thing.
Really, that comes down to, and the things you're talking about, is it is more difficult to look over the horizon, given that there are many different possibilities of where AI could take us, and you've got to keep your eye on all those different scenarios. How do you, as I guess, a principal of the business, but also just as a portfolio manager, how do you keep that agile mindset, knowing you've got to be adaptable, probably more adaptable than you had to be even 20 years ago?
I don't sort of really think about that specifically, Peter, because it's just every day is different, every month is different, every year is different. Like it's just part of the job. I mean, you certainly, we've had a experience in the last month, or actually, it's not the last month. Really, it's the last 6 months or so. There's been a particular style of investment that has worked well for a long time, 15 years, which is, quality growth as a style. And that has, unwound in a very large way over the last 4 or 5 months. And the question is why has it unwound? Now, certainly AI's had an impact on all the other bits and pieces, but maybe it was just trading at expensive levels for an extended period of time. The income portfolio that I'm sure you're wanting to touch on at some stage, it's more exposed to more mature businesses trading on lower multiples, pay out higher dividends, which is from a style basis called a value style. And that style has performed poorly over the same period, whereas now it's going really well. Things change.
But I think also, you're always trying to learn from them. I mean, you've got your principles and your fundamentals that you believe in, but the market and the environment changes, and I find, the amount we read and you try to learn and adapt to them, but you apply those principles and those fundamentals in a consistent manner, but just to different environments. And I think with cycles, whether it's value or growth, we have seen a bit of a regime change, probably along the same timelines as the direction of inflation has changed, to be fair as well. If rates, if we're not getting rate cuts and rates are going to be higher for longer, typically value or more income generative strategies, should do well in that environment. And I think that's what we're seeing.
Now, you touched on income. Obviously, that's a fairly recent addition, as we said from the beginning. We're hitting our 12-month anniversary, of that tilt. But it wasn't the first thing that we started to, I guess, evolve in terms of Elston's, evolution. We had large caps initially. We moved to small caps, and now more recently we've moved to income. Has that been part of a general, master plan? Is that how you've seen the business, moving in that direction, expanding the choice? Has that been something quite deliberate?
Yeah, that's exactly what it's about, Peter. It is about choice. If you think about, you might have younger investors who are looking for higher growth, higher risk type of product. You may have retirees who are looking for more conservative, more income focused, sort of lower volatility type of products. So it really is about choice, and it's about also not moving too far away from what it is that we do. So you're not producing a product that is completely from left field, where you have no comparable advantage to someone else already doing that. So it's about building out from, I suppose, the base is the way I think about it.
And Al, you'd have been working on this quite a lot. I mean, the whole team would have been working on the planning of this. We're talking about it being 12 months old, but the lead up to that, as you said, just in the design, the concept of how you approached the income portfolio, what were some of the things that you were thinking about, and how has that flowed through to execution?
Well, I mean, you mentioned horizons before, and I think that's interesting. So, typically, in a retirement portfolio where you've got more of a focus on income, your horizon is actually shorter. Like to these accumulation portfolios, your horizon, it is over the horizon. And you shouldn't really care about volatility. It's really about just maximizing returns, and you can handle deviations along the way. But if your horizon is shorter, where you need more consistency, then you need a fundamentally different portfolio, one where income is going to be typically a much larger component of return, where it's more stable, because you just can't tolerate that range of outcomes in the short term like you can when you're 20 or 25.
Yeah.
So certainly, I think thinking about the maths and the design of what we're trying to deliver, the outcome, is really critical to the ingredients that then you put into that strategy, because that's what it's designed to deliver upon.
You talked there about it being quite different in terms of a shorter horizon. There's obviously a fair bit more turnover in terms of what would be inside the portfolio. You are actually looking to move stocks on in terms of harvesting income on the way.
Well, there's a couple of things. I mean, I think there's three things really when you're putting together an income portfolio. I mean, firstly is you really need some diversification in that income. So it's not just coupons and dividends. Like you want distributions from managed funds. You want how those distributions are coming out, and so that's something that we really looked at, was trying to diversify. When my mum receives her income, she doesn't care whether it's a dividend or a coupon or a fund or a distribution from a fund. It's just cash coming into her account.
Yeah.
So how do we get that reliable and repeatable, right? The second thing is it's not just about income. Like you need income growth in real terms. I mean, bills are going up every year, so you need that income to grow in line with the bills. And the only way you get that is when the capital base is growing in real terms alongside that, because the capital is what supports that income. But then I think to your turnover point, the other thing is, I mean, we're quite advantaged in this country with the franking regime that, we do get the benefit of franking, and typically investors in that cohort get the full benefit. There's no taxation. So higher turnover or more of a dividend harvesting strategy. And this is where I think particularly ownership of direct shares, where it goes directly into your bank account. It's not going through a pooled vehicle where you're mixed up with everyone else.
Yeah.
Is a critical advantage of what, when we were putting it together, how can we make sure that benefit of franking flows directly through to the investor.
And also within the equities component, there are probably 4 primary periods of income generation within our markets. So you have full year reporting as at the end of June, and those dividends are normally paid in August, September. You've got out-of-cycle dividend payers, which are usually infrastructure, property trusts and banks. They're usually November, December. Then you've got half-year reporting as at December 31st. Those dividends are payable February, March. And then again with the property trusts, the infrastructure and the banks are usually May, June. So that's what generates the additional portfolio turnover, is you're repositioning to capture income out of each of those 4 periods. And what Al's saying is exactly right in terms of it can't just be about income. There's only 2 things a company can do with net profit. They can pay it out to shareholders, or they can retain it and reinvest it in order to grow the earnings or grow the value of their company over time. And what we're looking for with this portfolio is to generate a decent amount of income, plus the franking credits Al was talking about, but then also have the capital value of the portfolio grow with, say, if it could grow with inflation or a little bit more, it'd be achieving its role. So not every single company will have a high dividend. We'll have some in there that we believe will be able to grow the value of the portfolio as well. So that's what we're gunning for, a high level of income plus growth to offset inflation, and then franking credits on top.
Yeah, so it's not myopic. You've got both objectives in there, because you've got to be aware of them staying with this portfolio and reaping the rewards. Ultimately, when you came to put it together, constructing the portfolio, how different is it to, for example, the flagship? In my mind, it sounds like it would be very different in the makeup. Is that true?
Well, there is some there's some overlap from the managed fund side, but there are also a lot of differences. I mean, it is a more specialised portfolio. I mean, clearly, Bruce, in the Australian portfolio, like that dividend harvesting strategy is quite different. Now, there's a lot of common ownership with the flagship portfolio, but there's also a lot of differences, in terms of the stock, the yield, that's sort of the hurdle for stocks to get in there, creates some differences with flagship.
Yeah, it certainly does. I mean, if you look at the average yield within the All Ords, it's actually quite a bit lower than it has been historically. So you've really got to actually work pretty hard to generate a high level of income within the income portfolio. So if you look at a large difference would be its exposure to REITs and infrastructure assets within the income portfolio is a lot higher than flagship. Its exposure to banks is usually a bit higher as well. And its exposure to domestically focused mature businesses is higher as well.
But there are some sort of tactical advantages as well of having the direct. I mean, we're in an environment, for example, where a 10-year government bond is paying you 5% and higher for effectively a risk-free 5% yield. Now, the yield on the ASX 200 is about 3.2 plus franking a bit more. So, you don't get those opportunities that often where you can get a risk-free, but albeit with no capital growth.
Yep.
So then we need to balance that with the capital growth as you're talking about.
Yeah, absolutely. And probably the other thing that has changed with our Australian equities is the larger companies now have significant offshore operations, which they didn't really have to the same extent in the past. And that really affects the amount of franking credits that they actually generate. So if you're really wanting to hunt for high levels of dividend in an absolute sense, plus maximise your franking credits, again, it's slightly different from flagship that way. It'll have a lower exposure to those offshore earners.
But then on the more on the international side, and where we are using managed funds, we have worked with a couple of our managers to sort of on their distribution policy. Fortunately, we're big enough to have those conversations. Say, well, for example, if you invest in global real estate, income should be a pretty high proportion of your total return. The rents that you receive as a landowner should flow through. Now, because of a few different reasons, that wasn't flowing through into the distributions, but we were able to engage with our manager and adjust the policy to ensure that rental income came through with distributed more regularly and more reliably. And so that's the sort of things we're looking to do in terms of that specialisation of the particularly on the income side of the ledger.
So a lot of work's gone into constructing something quite specialised in the thinking and the strategy that's gone behind it. 1 year on, how is the portfolio travelling?
Well, it's actually doing pretty well. I mean, from a pure numerical perspective, it's about 11.5 or nearly 12, I think, percent. I mean, it's beating the benchmark, but the benchmark, that's not its main objective. I mean, the main objective is to deliver a yield, higher than the benchmark, from a yield perspective, and then to grow the capital in real terms alongside that. So it's definitely ahead of those objectives. And internally, we have a soft target of a 5% yield, which I think once we get the full distributions from the June year end, I think we'll be pretty close to, and I think we'll be pretty happy with that outcome in an absolute return sense.
And the reason for that number, Peter, is because this is a target, a portfolio targeted at retirees, they usually have to pay out 5% of their superannuation as income to themselves each year. So if you can match those cash flows, and then you've got inflation offsetting, growth offsetting inflation, well, then that's the portfolio has primarily done its job.
Yeah, you can keep one step ahead. What I like about the income portfolio, you talked about it being a very different, very different type of client that it caters to, but it also, in terms of widening the Elston choice, talk about the wealth journey, it really does allow you to now have, I guess, a bit of a range of options, and people can use Elston in different ways, and this could be quite specialised for a very specific type of person. You think about that wealth journey, we've probably got a pretty good coverage across the wealth journey and different sorts of attitudes and, risk appetites of clients. Is there anything else in the pipeline that Elston has planned to continue to offer that choice across the wealth journey?
Yeah, I mean, you're right. The product suite at the moment covers everyone from a young age who are chasing higher growth through to retirees who are chasing more income. And then obviously you've got the demographics in the middle. Probably the other area where we're looking at and doing a lot of work on is risk versus return and how people perceive risk. A lot of clients will look at us and judge our performance based around return versus a benchmark, which is fine. I mean, that's convention and that's the way it's done. But the end investors often have an absolute return requirement. So there's a differential there in terms of, someone may require 8% per annum in perpetuity in order to do what it is they want to do. Whereas that's got very little to do with what the benchmark does and how we're judged. So it's getting that right. So, a lot of our current products are really based around generating a consistent return over the longer term. But that doesn't really satisfy those clients who want something that tracks a benchmark. And so it's that product that moves fairly similarly to a benchmark is where we're doing a lot of work at the moment.
We're calling that the Core series. And I think, when we were talking about evolution before, I mean, the market, in our view, does appear to have evolved, particularly in the last 3 years with the change in the superannuation rules for some of the large industry funds. And I think that, that momentum that's driving, versus fundamentals and other considerations have fed into that design of, I guess, that choice to be able to provide that, to say, well, if the landscape has changed in terms of, the variation from the benchmark from pure price-driven momentum versus more earnings-driven or whatever else is driving it, then I think, we need to sort of recognise that and reflect that in an offering that might suit that environment. So I think that's certainly featured into the design for that Core series as well.
Yeah, it's the changes that Al's referring to are I think it was Your Money, Your Super, where the large industry funds were held to performance tests and they weren't allowed to deviate far below benchmark returns. What that has meant is that there is a lot of grouping around the index constituents. So your largest companies are attracting a lot more of the flows into them, regardless of how they're valued, regardless of how they're performing, than has been the case historically.
So being close to the core, being close to the benchmark, I mean, how do we make this not just a benchmark hugger? Like, what specifically have you been thinking about in terms of how you design the core offering?
Well, I think it's recognising that, in certain parts of the market where these momentum or there's these, investors which are owning the largest shares in size, like we need to reflect that. But that doesn't mean that we can't allocate capital to areas where, may be less efficient or where fundamentals are still more powerful, and you can generate outperformance in that areas of the market. So I think it's a hybrid in that sense of trying to allocate, that active component where you get, the most bang for your buck, and it produces a ride that's probably, at least in the short term or from a relative perspective, might be smoother. But yeah, I think those underlying principles about long-term fundamentals, there's no change in terms of how they will be, will be rewarded for those.
The difference is if a company is 5% of the index and we don't like it from a valuation perspective, in flagship we'll probably have zero weighting to it, which is a major difference to the index. In the core series, it might be, say, 3 to 4%, held at 3 to 4%, which is underweighted its exposure to the index, but we still own it because it's a large constituent of the index. So it just tempers the variation of that portfolio to index returns. Probably the other complication that we had to take into account was Elston's heritage is direct portfolios, so owning the portfolios directly. We had to cater for that within the core series, which makes it a lot more difficult to do. So that's been catered for within the structure of the portfolio.
But I think also, like in terms of evolution, I mean, the demand evolution, I'm talking more about income here again. Like I think as that balancing point is tipped of, the population who have entered retirement or moving into retirement, I mean, you would have thought, 5 years ago when interest rates were zero, there'd be a huge demand for income products. And there was, but my sense is that tipping point has really moved from a demand perspective where more people are really seeking out those retirement solutions because that's the stage of life that they're in.
That'll be accelerated tonight by the federal government budget introducing higher capital gains taxes. Yeah. So
you think there's some shockwaves?
So that'll probably push people. Well, franking credits are still in place, so it's a franking credits are very advantageous, particularly if you're a retiree in a 0% tax environment. Franking credits are absolute gold.
So you're thinking there's going to be some shockwaves for the boomers?
Well, I just think everything's income or total return is made up of income and capital, and the changes to the drivers of those from a tax perspective may lead to people changing their portfolio to match.
I think when the budget comes out, we should regroup and have a chat about it and see exactly what they put on the table and how that's going to be received. And then, as you said, how people are going to change their thinking, because things like the income portfolio will be looked at in a perhaps even more favourable light than it has already.
Well, I think, and I mean, thinking about tax, it's one thing that we do think about when we're designing these strategies. Now, whether it's purely franking, or whether it's when we think about an accumulator who might be 20 or 25. Now, in the current environment, up until tonight, obviously you want as much return as possible to come through capital growth because you're getting compound, you're getting returns on returns, and you're getting compound. And up until tonight, you get a much more favourable tax outcome. If that were to change, then I think it's one thing that we probably do a little different to a lot of managers. We do think about the after-tax outcome, whether you're in accumulation or whether you're in income, and how what we can do to recognise that in terms of improving the outcome.
Yeah, well, for the end investor, it's after-tax, after-cost results are really the only thing that matters.
Well, that's what you eat.
Yeah, and that's what's left over for you to actually survive off. And so tax is a major component of that, particularly in Australia.
Well, that's fantastic, guys. I mean, talking about things that you need, we're obviously not eating birthday cake, but it was great to come back a year from inception and actually see how the income portfolio has gone. And it's great to look back and see how Elston has evolved and will continue to evolve. Thanks for coming in today, and thanks for sharing your insights on the income portfolio.
Thank you for hosting us, Pete.
Thank you.
That's all for this episode of FM Radio. I hope you can join us again soon as we tune into another aspect of funds management that affects you and your clients. FM Radio was recorded at Elston House. For more FM Radio episodes and full transcripts of the interviews, visit elston.com.au. And if you'd like to subscribe to our podcast series to make sure you don't miss a thing, You'll find FM radio on your favourite platforms, including Spotify and Apple Podcasts.
The information provided in this podcast is general in nature. You must consider your own circumstances prior to making any investment. For more information, go to our website or speak to your financial advisor. This podcast has been prepared by Elston Asset Management Proprietary Limited, a corporate authorised representative, CAR 427434, of EP Financial Services Proprietary Limited, AFSL 325252.